Welcome, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer, as a reference point. We expect you to do your own financial research and make your own financial decisions.
Okay.
Today is
Wait.
Sunday, June 6th, 2021, and this is Blockhead Traders Weekly. This week it's myself, Sprocket888, joined by fellow Blockhead trader Viper XL 007. This week we're going to be continuing our mini-series on how to start trading with the topic of trading psychology. And trading psychology, we'll be talking all about the mental toughness that's needed to be successful in the trading game. But before we hop into this week's main topic, I want to give a shout out to the Discord that we run. You can find a link in the description below. It's free and open to anyone who wants to join. We'd love to have you hop in the Discord, say hello, ask some questions, tell us what you want to hear more of on the channel, tell us your trading style. Just join us and hang out with us. We'd love to have you. As for this week's topic of trading psychology, I'm going to bring in Viper XL 007, and we're going to talk about all of the mental things that can go on in the world of trading. And to start us off, we're going to run down a couple of lists here about things to consider when it comes to trading psychology. And the first point that I want to bring up and we want to talk about for a bit here is making money versus making good trades. And you sometimes think that that might be, of course, that they're the same thing, but not always. There are good trades that can be made where you don't typically make money sometimes. That's just the way that it works out. The important thing here is you absolutely cannot be in the game of trading with a goal to make it overnight. So, you might hear on Twitter somebody that turned $5,000 into $100,000 or took $2,000 and made $1 million. And that's just really not realistic. And you got to get that out of your head that that's just not an achievable thing for normal people. And for every giant success story you hear about on the internet or some video, you're probably not hearing about 99 terrible stories that went against that particular trader. And it's really a tough thing to wrap your brain around because everybody likes to talk about their wins. Everybody likes to talk about the things that went right. Everybody likes to exaggerate their wins and exaggerate the things that went right. And a lot of people don't talk about the negatives and they kind of ignore the negatives and pretend that they don't happen. And that can often lead you to think that everyone else is getting further than you and you are just kind of struggling. And that can lead you into situations where you do what we call chase the money. And you absolutely never want to chase something. Very often trades will develop and they're done. And you might see them after the fact that they're done or you've missed the beginning. And it's very important to realize if you've missed it, you've missed it. And you can't chase a trade. The more that you chase a trade, the farther away it's going to get and the deeper into the hole that you're going to come. And so really the first thing about this trading psychology is kind of overcoming this constant barrage of internet signals telling you that everyone else is doing better than you.
Yeah. So, I mean, I personally can't stress enough the not chasing a trend, chasing money. And to keep it even simpler, you're chasing something if you've heard about it, if you've heard about something happening on Twitter or in the news or whatever, wherever you get stock information, if somebody's already talking about some big explosion, some big trend, you're probably too late and you're chasing it. That's just a good rule of thumb. The whole idea of all of the fundamentals and the metrics that we have previously talked about, price action, price levels, all that kind of stuff. All of that is how you catch the trend at its start. So that way everybody's talking about you because you plotted it you got there first and you're already riding it. To jump in halfway up the wave is just always going to be a recipe for disaster because it goes against the fundamentals. You're already halfway up. And so you're going to get emotional. It might backtrack on you. And you would have been safe if you played it normal and jumped in at a good time. But if you miss that and you try to jump in when everybody's talking about it, that's chasing, and it's a
Yeah,
recipe
absolutely.
for
And
disaster, hurt and
the
failure.
next point that I'm going to bring up, and this one is really tough because it's very very specific and unique to each person. So I'm going to try to talk at it in a general form, and that's you never know how you personally are going to react until you're there. So, you might think that you know how you're going to react when you're down $100 on a trade. Um, but the reality is, if you've never been down $100 on a trade, you don't know how you're going to react. And likewise on the flip side, you don't know how you're going to react when you're, $500 up on a particular trade. So take any trading situation, and unfortunately, how your mind is going to treat that and how you're going to react to that situation, there's no good indicator to really know. Me personally, I've always been pretty level-headed when it comes to things, and I find myself in certain situations almost getting a little nervous at times in my trading journey. As the younger I was, the first time that I was down by a significant number, or the first time I was up by a significant number, and what I thought would be a very level-headed, methodical approach, I find myself just kind of playing mental games with my own mind about freaking out. Am I doing this wrong? Maybe I should. Maybe my strategy is incorrect. And we're going to talk about this, strategy and plan here in the next couple slides. But what I found is the most successful way to combat this, you don't know what it's going to be like till you're there, is document and record in some type of journal the things you were thinking, the things you were feeling when you're at these extreme situations, so that you can reflect back on that once your mind has calmed down, once the situation has passed. And you can just be, there's really nothing that you can do to prevent your reaction from that, but knowing how you react mentally to those situations just helps you be prepared for that when the time comes.
Yeah, absolutely. I mean, and we'll get into a little more of the details in a little bit, but it's there's if ever there was one quintessential point that everything in the last week's episode was driving towards, it's almost like it's this. I mean, it's all connected and all, but this is where everything comes into play. Of you never know how you're going to react, and one guaranteed way to ease that reaction or assist that reaction is all of those fundamentals, those financial fundamentals, and having all of those in place such that that is one block less on your worry meter, because this is going to be a surge of new feelings, new emotions, new thoughts of, what, and that whole piece of like, oh, if this goes wrong and I lose all this money, I can't pay rent or something. Like, that's one thing you just cannot worry about in the heat of this moment. And it's also a thing that none of us can explain. None of us can fully help you with. And that's why we say bite small. But, paper trades are good, but when you go to real money, bite small, feel it out, scale up with comfort, or with confidence, as your confidence allows, because you just don't know until you're there. So just be prepared for not knowing, and try to, help yourself out any way you
Yeah.
can
The next point I want to bring
to
up is,
be ready for it.
you might have heard the old adage, measure twice, cut once when building something. I like to kind of liken that in the world of trading to think twice, execute once. And this really goes down to be slow, be methodical, be conscious of what you're doing. We're going to talk about strategy here in a second, but really getting out of a trade is a lot tougher than getting in. Getting in a trade is simple. You throw it up on your screen, you push buy, and you're like, yeah, I got this. But getting out when something goes wrong, or not considering a certain aspect of the trade before you enter, that's stuff that is really gets to you. And consider your trade, look at it again, look at it again. I mean, even myself, I find myself having a particular trading thesis on an underlying. I get in to start looking at the option chain or the candles of the movement of the chart, and all of a sudden I'll see a big candle and I'm like, "Oh my gosh, it's happening right now. I got to put the order in." You got to take a step back and you got to make sure that you have all of your bases covered for your trading strategy. For me, on some of my strategies, I keep a checklist. And if I don't run through that whole checklist, I don't execute that trade. And that's so, so important, because there have been times where I've skipped that thinking I was going to be missing something. And I executed the trade. And about 30 seconds, 1 minute later, I'm like, oh my gosh, totally forgot to check this. This is like one of the red flags in my strategy where I shouldn't have entered this. And then you got this like buyer's remorse, because yeah, like I said, getting out is a lot tougher than getting in. So think twice, execute once.
Yeah, absolutely. And think of thinking twice as buying yourself buffer for what you're undoubtedly missing, because I don't care how good you think you are. I mean, I've fallen into the trap as well. I don't care how good I think I am. You are not. I'll look at a chart and it'll start to do the thing I thought it was going to do, and then I'll be like, "Oh, this is it. I got to go." Uh, Nobody's that good, and don't think you're that lucky that you just happen to catch it. Just that's confirmation bias. You went into it thinking it's going to do this thing. The first sign it's doing that thing, you think that's it, and you're confirmed, and you try to jump in. That thinking twice gives you that buffer to take a step back and go, "No, wait, no. What was the if it's a checklist, like Jeremy said, like take the steps and go through it, and the next thing you know, oh, it wasn't the thing I was looking for, and now I can think more
Yeah.
clearly,
and
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 be
and
more
kind of
measured in the entry."
similar to that, only it's on the flip side of the trade. Once the trade is over, never do what if math. And this can be phrased in different ways. I'm hesitant to say never look back, because I think looking back at the trades that you've done, as long as you're journaling them properly and recording about them, you can look back as a learning experience to sharpen things, that your strategy, tweak for certain variables. But you absolutely cannot look back and say, but what if I did this? What if I didn't sell? What if I'd have held on? Um, because that is one surefire way to really just wreak havoc in your mind. And it's going to make you hesitant in the future trades, because you're going to have this in the back of your mind, like, oh, well, the last time, if I'd have just, it doesn't matter. You have a strategy and a plan for a reason. Stick to it, and don't play this what if game.
Yeah, this is a big one for me, because I still, full disclosure, to this day struggle with it, where I'll make a play. Let's say it was a 100 share sized position. It'll execute perfectly, and I'll be methodical, and I'll close out, and I'll take a profit or whatever. And then I got that success in my under my belt, and so then I'll click the button and pull up the calculator and be like, "Oh man, like I could have afforded 200. What if I just done that?" Like, and then I'll run the math, and like you'll be like, "Oh man." I mean, that's easy. It's a double, but still, I'll get the calculator out and be like, "What if I had sized myself differently and really gone after it?" And that's where you then create this false or sense of urgency on your next trade. Be like, "I'm not going to make that mistake again." And that's why it's critical above all else to make your plan and stick to your plan and understand your plan end to end, because on every move anything ever makes, there's 1,000 different ways to play it. Some people are playing a long game to go down. Some people are, there's just all kinds of moves you can make. You've selected your move, stick to your move, and no matter what happens, if you get out and it bursts for another 1,000%, you can't think about it. you successfully executed your play
Yeah,
and
yeah,
anything
it's
else
it's
was
a real
not your
tough one,
plan.
and
Walk away.
it's one that inevitably, no matter how good or how experienced you are, it's just a phenomenon that will always be there haunting you. And just be aware of it, be cognizant of it, and just don't let your mind go there. The last point that I want to touch on here in this particular slide is find a mentor or mentors, possibly. And really, where this comes in is, you're learning. It's really hard to learn anything in a vacuum, in a silo. There's all kinds of resources out there online today, different Discord rooms, different online communities, different people that trade like you, people that don't trade like you. I would highly encourage you to find a mentor that matches a similar trading style to yours. A lot of cities and communities actually have physical investment clubs or trading clubs where you might be able to meet up with someone in person. The only thing I would caution you when you're trying to find a mentor is a good mentor is not going to charge you money. If somebody is paying to mentor you, if you're paying someone to mentor you, that's not a mentor. That there's incentives there. Otherwise, just genuinely find someone who's out there in the trading community, and they're everywhere. And if you can't find anybody, you know, log into our Discord and chat in there. But finding a mentor is oh so important, because bouncing an idea off, or if you can't even find a mentor, find a someone else who's on the same learning level as you and learn together. Go back and forth, because is really that's the best way to kind of keep some of things in check. Otherwise, your mind will start like feeding upon itself, and your thoughts could spiral into um, situations where it lead you to negative consequences and negative actions. So these are the key points that we wanted to bring out here in the introduction topic of trading psychology. We're now going to go into three separate areas, which we believe are really big keys into mitigating mental fatigue and basically keeping your mind mentally tough when you're engaged in the act of trading. And the first one, and you're going to hear a lot about this. In fact, the third installment of this How to Trade is going to be all about strategy. So we're not going to go a lot of in depth here into different strategies in this particular episode. That's going to be saved for next episode. But really have a strategy and a plan. And what I mean by that is start with a strategy, and a strategy is really your roadmap, your operations manual on how to execute a particular trade. What are you trying to do? There's all kinds of strategies out there, but a strategy has rules. They have rules around entry, they have rules around exit. They have rules that, while you're in a trade, when you see this, this means this, or when you see this, it means that. Strategy is all about the type of trading that you do, and it's all about the rules that are associated with that type of trading. There are all kinds of strategies, infinite amounts of strategies out there. And one of the key things that's important to do is figure out what strategy you identify the most with. Because the more interested you are in a particular strategy, the more likely you're going to be to research it, the more likely you're going to be to follow it, and the more excited you're going to be about it. And so, really, it all starts with identifying that strategy. So the next one with the strategy is always a plan. And you really need to know the plan. So it's not just, I pretty much know the general idea. No, you need to know this plan inside and out, backwards and forwards, up and down, left and right, east and west. Because when you're in the heat of the moment, when your stresses are high because the chart's moving against you or the chart's moving with you, and you're euphoric with victory, you're not going to be in a stable mindset, right? Your mind is either going to be extremely biased negatively if you're in a negative situation, or you're just going to be a feeling of invincibility and you're on top of the world, which in each case is going to lead you to bad decisions. And the only way to keep that stuff in check is to reference the plan and know what it contains. So, you know, every plan is going to have all the different aspects that could happen kind of mapped out or talked about. And that's the stuff that you have to know. And no matter how bad it looks or how good it looks, you have to remember to stick to the plan. So you can't, put these heroics like, oh, well, I'm down like, 50% and this is my plan says you got to get out now. You know what? I think it's wrong. I'm going to double down on this and really, really come back and have this roaring comeback. Those type of heroics, they work in Hollywood. They make good movies. They make good Twitter posts. They make good Reddit posts, things like that. But they don't work in practicality in real life. It's super important that you absolutely stick to the plan under all conditions. And it's so much easier said than done because in the heat of the moment, your mind is going to tell you, well, the plan it's a guideline, but in this case, we know better. That's not the case. And that's why it's so important to know that plan inside and out. And kind of along with that, this is really this idea of logging and journaling. And you'll hear us mention this several different times because, you know, you're never going to remember exactly what happened and when it happened, right? So let's say you're in a bad trade or it's going against you, you exit, you freak out, you sell, you close out the position, whatever it is. A month from now, your mind isn't going to remember all of the specifics around that trade. What were you thinking? What were you feeling? What was the sentiment of the market? And the more you can log all of these things in some type of journal, some type of spreadsheet, what were your entry conditions, your exit conditions, your thoughts, your emotions, all of these things, I wrote down on here, log what you ate for breakfast. Not, you don't really need that part, but what I'm saying is the more data that you put in there in journal, the more beneficial that's going to be to you when you look back on things and try to reflect on, how things are going. How can you make yourself better as a trader? What things has gone right for you in the past? What things have gone wrong for you? And the context around all of those things. And so really all of these things put together, have a strategy, stick to the plan, log it all. This is really one of the big first mitigations in dealing with high stress mental games when it comes to trading.
Yeah, absolutely. I mean, to me, all of this stuff being interconnected, uh, if you're going to go in to make a play and you don't have a strategy and you don't have a plan, don't call yourself a trader, call yourself a gambler. I mean, that's essentially what you're doing. You're throwing money on the craps table. And I get that. I get it that in some ways that's what we're all doing. But there's a method. Put the method to your madness and have that strategy, know that plan, and utilize the tools that are available in every legitimate trading platform out there. Um, to make you robotic. I mean, you can try to be robotic in your mindset. You should always strive to be as robotic as possible in your mindset, but you're never going to get 100% there. And that's why there's things like limit orders, stop orders, and all that kind of stuff. So that way you first have your strategy, you know your plan, you run it back and forth in your head. This is you read the charts, you do whatever you're going to do on the specific strategy, and then you go one step further and you place your orders ahead of time. There's all kinds of different types of orders, and maybe that's a future episode talking about all the different order types. But you put these things into the system. So now the system is carrying out your plan and you are watching it go. Um, and so an example of where this is important and one way to react, say a stock is at $1 and you have a plan that you think it's going to go to $1.50. You think it's going to also hit $1.20 on the way. So you go in and you put your order you put a sell at 120, you sell the rest of it at 150. You got this nice plan to separate your profits. Uh, and if the stock goes up, it very well could hit 119 and then plummet, and you got a stop loss set at 90 cents. That's your plan. I mean, you can crash and burn out and still take some profit at 110 on the way back down, or you could just hold out, let it hit your stop loss. You took the loss, you measured the loss. That was a known risk. That was a known loss. It was mitigated. You knew what was going to happen. Um, and that's just the way it is. Like, that's one of those examples where you can't let that get in your head of, oh, it's so close. The only thing you can take out of that is, how could I have tuned my level better? And if there is no answer, then it is what it is. And you just roll on to the next trade. And sometimes you miss, sometimes you will miss just by that much. Um, but as long as you miss by that much while laying out a plan, having a strategy, it's that much easier to just brush it off, move on. You were validated, you learned whatever you needed to learn. Let's go do it again.
Yeah. And building upon this strategy and a plan is really where the next thing that we want to call out as a mitigation. And that's the next logical step. Once you have a strategy and a plan, test that strategy and plan. Um, and there's a couple points here that we're going to touch on. The first is there's many ways to test a strategy and plan. A very popular way is paper trading. Um, Paper trading is basically like a mock trading account. Almost every brokerage out there supports this. You log into the paper trading account. You get some balance put in there. Usually it's like $100,000. You can treat it whatever amount you want. And in the paper trading account, it receives the same market data as the real market. And you basically would execute trades as if it was real money, but it's paper money. And this really lets you see how your strategy and your plan would pan out without actually risking any of your own capital, which is a great way to test theories, test ideas. It's with real market data. You usually do this while the market is open. You typically can't paper trade when the market is closed. Um, it's a great way to test some of this. And I do want to call out a lot of caution here with paper trading. I am not a fan of paper trading, and really what it is for one reason, and it will not simulate the mental stress and strain that your mind is going to go under. Because at the end of the day, it's paper money. And, you might run your strategy and it might be winning and you might be, this is great. Oh, my emotions, I'm so chill. This is so easy to do. And it's a great way to see mechanically how your strategy and plan work. But do not think that the way that you react to a loss or a victory in paper trading is how you're going to react when there's real money on the line. I promise you, you will react differently. And as long as you keep that in check and you understand that, I'm all about paper trading. But I think paper trading gives a lot of people that don't understand this bit a little false confidence in their strategy, because it makes them think that they can handle this. And it makes them think that they're going to be cool as a cucumber when their positions get under strain, or on the upside if they're winning victoriously.
Yeah. One one image that just came to mind just now with paper trading is almost, you can think of it like, we've all seen the big, uh, just ridiculously accurate Boeing 747 cockpit simulator machine. It simulates everything except the knowledge that what you're doing is real. Like that, what you're doing is a simulator. And so to me, paper trading is along those lines. And the paper trading's best asset is, like, I mean, how I used it was navigating the tool set, navigating the dashboard. I want to understand, because when real money's on the line, I don't want to click the wrong button. I don't want to send the wrong order. So especially when I was getting into options, and that was just a whole nother thing. And using Thinkorswim for the first time, there were all kinds of things that I didn't know how to get to it. I still don't on some things. And so paper trading is fantastic to just bumble around in the tool, click buttons, find your order type, find out how to do it, how to execute it. Um, and so it is a great simulator in that regard. And it is still great if if you know you're one step above, you know how to place your order and you want to test something. Um, but yeah, like Jeremy was saying, absolutely distance yourself from anything you're feeling while testing it as to how it's going to go in the real world.
Yeah, yeah. There's a lot of great things that paper trading is good for. You just have to be aware of the things that it is good for, and be aware of the things that it is not good for. The next point that we want to bring up is what I call look back trading. And this is really, you have a strategy on paper, you have it written down, you have it in your head, you've been researching it, something like this. And this is simply, whether or not it's going to tradingview.com and pulling up a chart and just scrolling back in time to the time at which whatever conditions were met for your particular strategy. And you just pretend, if I'd have entered here at this, what would have happened in time? Oh, and if I would have exited here, it's basically just manually looking back, and kind of executing your strategy, executing your trade thesis and things like that. And some brokerage tools even offer look back trading, where you can basically rewind market data to some point in the past, and you can push play and it plays back the market data as if the market is actually happening at that time, and you can enter trades and exit trades. So it's kind of like paper trading, except where you can rewind the market data and replay particular days, and trade on those days. And that's another great way to kind of go back and test your strategy and your plan. And the next point is back testing. So this is also similar to paper trading in a way. It's similar to look back trading, but this is a little bit more programmatic and algorithmic. So, this can be done if you happen to be into programming. You can generate a lot of back testing things in Python and other scripting languages. But there's also a good number of services out there that offer back testing platforms where you can basically enter the parameters of your trading strategy, and you can go back in time and back test it over the past 10 years, 20 years, with market data. These services are usually never free. You usually have to pay for them. They do offer trials. I personally have not necessarily used any of those automated back testings. However, I have looked at them, and it might be an interesting topic of a future episode to maybe take a couple of the front runners, maybe sign up for a couple of free trials, and do a future episode on that. Just know that those options are out there, and it's a little bit of the next level up from the paper trading or the look back trading. You can Google and do your own research on that topic. And then the last step of testing your strategy and plan is, it's actually trading with real money, your own real money, following your strategy and plan. The difference here is, you start smaller than your position sizing would lead you to believe. And position sizing, we actually did a previous episode on position sizing. You should go back and watch that. But it's really, when you decide about how big of a particular position to take out, given a strategy and plan, what this is saying is, hey, before you have a lot of confidence in your strategy and plan, maybe you've tested it, maybe you've paper traded it, you've done look back trading, but you haven't gotten that whole all in feeling yet. Maybe start out with 1/10 of the size, where you can kind of see how it plays out with real money on the line. And as your confidence grows in that trading strategy, then you increase your capital allocation to it. Now, keep in mind, you should never increase it past your position size, right? The idea here is you're scaling into your plan by starting much smaller than your position sizing would allow. But as you gain confidence in it, you're going to expand that position or expand that capital to the actual full position size.
Yeah, for me, look back trading is something I'll do fairly regularly. Um, when Probably in a couple scenarios. One, when I want to review something I did, either if it was successful, if it was a failure, it's the way to check the tape. Go back and see what did I miss, or did I miss anything, and it just happened to turn on me, for some new, completely new reason I didn't anticipate. Um, or I'll look back if I have a new idea, like some of the strategies I've talked about in previous episodes, and one new one that I'm working on now, that maybe we'll bring up in a future episode once I've looked back enough to see how successful it is. But I have this plan in mind, and it's on a particular chart pattern, and so then I'll go to look back trading, where I'll grab different stocks, and I'll just scroll back in time, and I'll look for this specific pattern, and I'll see if it reacts the way that I'm expecting it to. And if I really wanted to, I would, could go into uh either the back or the rewind feature and actually play it in real time. But usually just look back trading is good enough for me, to get that sense and confidence of if this pattern is actually working out, or if it makes itself and then disappears. Um, and the biggest thing here, though, is the scale into your plan. That's been huge for me. And I mean, that's how I got into comfortability with most things options related. I mean, just grabbing a tiny little, you know, an option once I understood how to mitigate the risk and manage the risk, to be like, oh, you mean if this thing blows up, I lose $10? Like, okay, let's just do that. And take the nibble, because again, keep in mind everything that we said at the beginning. You're not in this to be a millionaire overnight. The Lamborghini's not in the mail. It's you're on the long term mindset. So what is it really costing you to take a day, a week, a month, whatever you need to take these little nibbles and really feel it out and start to scale up? That's how you build sustainability and comfortability into the future.
Yeah, absolutely. And before we slide to the next couple bullets here on the next slide, um, when I was first getting into premium selling, which is a strategy that I follow, um, the type of trading when I was scaling into it, my very first trades, we'll talk about this later, were 50 cent credit spreads. So, I was my max loss on these one lot 50 cent credit spreads was like $40, $38. And yeah, that's a very small amount, which I didn't lose any sleep over. And it really helped me see the mechanics, and really start scaling up into much larger, more appropriate position sizes. But I started super, super tiny, just to see how it actually worked. And it's very, very, very useful. And so the last point, the last set of bullets that we kind of want to go over, and these are this is near and dear to my heart, but it's take risk management seriously. A lot of people, you'll hear, oh yeah, I won this, and I'm winning this, and oh, I don't want to lose this. One thing that really sticks out to me is trading is not a finite game. There is no such thing as winning. You cannot be there's no end game in trading where you're declared a winner. The only thing that happens in trading is you can be declared a loser. You can run out of resources and have to exit the game. There's actually a talk that I've heard on YouTube, by Simon Sinek, and it's called The Finite Game, or something to that effect, where he basically talks about the difference between an infinite game and a finite game. And if you ever enter an infinite game like trading with a mentality of something that is a finite game, you absolutely are going to get destroyed, because in the world of trading, there is no end. So it is all about the next bullet point, which is capital preservation is king. You have to preserve your wealth. You have to preserve your capital, because once those resources are gone, once you're out of your capital, you're done. You have to exit the game. So in that respect, it's finite, but it's only finite if you run out of resources. As long as you have resources, you can keep going. So there's going to be months that are bad months for you. But the key is survive those months to keep trading in subsequent months to make back some money, to book some wins. If you get your position sizes off and you lose all your resources on a couple of plays, you're done. It's over. You're out of there. And so being aware that this is not a finite game and there is no such thing as winning will totally shift your mindset around how you trade. You're going to then find yourself trading more defensively, because what you're going to do is you're going to start looking at this and saying, okay, I want to make this trade and I'm going to risk this much money, but I'm going to be defensive about it because I need to preserve my capital. And there's all different kinds of trade defenses that are out there. And it's very important that you understand what defenses are available to you. Position sizing is one of the biggest types of defenses that are out there for you, and that is, never actually allocating more than 1 or 2% of your portfolio to any particular position. So, if that position blows up and goes south, okay, you got 99% of your portfolio left, or 98% of your portfolio left. And that in and of itself is a capital preservation tactic that will let you stay in the game and let you preserve your resources. There's other defenses known as hedging. This is when, you take a look at your particular portfolio and you notice that, hey, I'm very biased in one particular direction, in one particular area. And hedging is basically taking an insurance out, or making a play that is almost the exact opposite of that, to try to keep that in some type of balance. So you're not overweight in one particular area, which would make you susceptible to getting a big chunk of your resources knocked out. And along those lines is diversification. You'll probably hear this all the time in investments, because diversification is a great mitigation of risk. If you're investing in consumer discretionary and information technology and materials, these are very uncorrelated sectors. And the chances of all of those uncorrelated sectors blowing up at the same time is quite small. And so as long as you can keep a lot of these defenses in play, that's going to help you preserve that capital. And the last point that I would bring up is, a lot of times people think, well, I'm trading, I got to keep trading, I got to keep trading, I got to keep playing. Sometimes the market conditions are taking no trade is actually a valid trade. Look back to March of 2020, where the market lost 30% of its value in a matter of weeks. Nobody knew what was really going on. And anytime you get into these really uncertain areas, you're out of your comfort zone for your strategy, you're out of your comfort zone for you as an investor. Take a step back, scale your positions back, sell some stuff off, because it's all about capital preservation. And sometimes taking no trade at all is absolutely a valid tactic and strategy to deploy.
Yeah, the only thing I want to touch on here is the capital preservation, and the no trade is a valid trade. And just as, I mean, capital preservation is going to, the idea of it is pretty universal. The implementation of it is going to be very personal to the trader. But just for thoughts, for your thoughts purposes, the way I approach this is, in my account, I have a watermark, of a certain amount of my underlying capital. And if I'm taking losses, my capital's coming down and I'm approaching that watermark, I start to tighten up. I tighten up. I tighten up. I take less trades because that's a hard watermark for me. I want to preserve that amount of capital, uh, such that, in a favorable environment, when I'm netting some profits and things like that, I have this you know bulk of the capital available. Um, and then on the flip side, as I'm getting away from that, I'll scale up my aggressiveness. My position sizing will be in relation to where that's at. Then I have a plan of, if I cross another certain point, that's my new watermark, and then I'm going to stick to that, and I'm going to reset back down. And it gets to the point where if I'm threatening to break that watermark, then call it off. If there's something super safe, which is rare, but something I'm super comfortable in, I might still enter that to try to start nibbling back up, or I'll just straight up wait, and I'll bring fresh investment in. I'll through the budgeting, I'll bring fresh money in and start to build myself up over the watermark and start entering back in. So to me, that's important, to that this game is flexible to you. Don't feel the pressure of, I got to get in there. I got to keep doing this. Otherwise, I'm screwed and I'm not going to make money. That's just not the way it works. There are ways that this can be on your terms. And that only happens when you make the strategy, make the plan, stick to it, own it, tweak it as necessary, and embrace the idea that knowing when to call it quits, I mean, not quits, but knowing when to call off a trade and not make it, whether it's because technicals don't add up or your fundamental financials are not in a favorable place to enter that trade, take no trade. Keep your eye on the long game and have that long-term plan.
Yeah, definitely. So those are the main points that we wanted to bring out in this episode of Trading Psychology, to kind of tie a couple things together here. There's a reason that some of the most profitable trades that happen out there in the marketplace are run by algorithmic robots. So there's a huge industry in programming algorithmic trades and then letting those things run loose in the markets and basically make and execute trades. And the reason for that is really what this episode is all about. And it's that mental game that humans just find themselves in. And so the more mechanical you can trade, the more robotic that you can trade, the more advantage that you're going to have. And the problem, like we mentioned, humans are human, and you are never going to trade just like a robot. And there's always going to be this mental aspect to trading. And really, what this is about is mitigating the impact of that mental aspect, making sure that mental game is as clean as possible, that you don't have extraneous worries, that you have clear indicators of what to do. And all the things that we're talking about are to help get you in a better mental place so that when your mind comes under the mental stresses of trading and all the environments, that you are in the best possible position to defend off that and still make good, logical, and sound decisions in the heat of the moment. So, this is a huge topic that is very kind of subjective. Everybody acts differently under the pressures. Love to hear any feedback, comments, things, stories of your own, or, things you want to hear about with respect to some of the stuff that we mentioned in this video. Leave a comment on below about that. And Mike, I don't know if you have any kind of closing comments that you want to bring into this discussion on trading psychology.
I mean, just embracing, like we talked about, the community aspect. I mean, whether it's comments below, whether it's Discord, whether it's even us, whether it's some other group of friends you have, um, that's the way you're going to improve on these things, and find that methodology that works for you. Um, Embracing that community, that mentorship via community. these are the things that, I mean, obviously we need as well. And so that's why nothing we say here really means anything, because it's just our current place, our current view, our current process, and everything's up for discussion.
Yeah, so that is trading psychology. Next week, we're going to touch a little bit on trading strategies in part 3 of the How to Become a Trader. Looking forward to that episode next week. We're going to touch on various trading strategies that we're familiar with. Give you other trading strategies that we're not so familiar with, that you're probably going to end up researching a lot on your own. But it's the beginning of a new week. I want you guys to have fun out there trading. Good luck this upcoming week. And remember, think outside the block.